Hi folks, welcome back as we move on to chapter 9, the last chapter before our next test. This actually is a fairly short chapter. It'll be pretty quick. It'll still be broken down into two segments, but I don't think either one will be too long. The next one will definitely be shorter than this one. We're talking about responsibility accounting for cost, profit, and investment centers. What we start off with, as we're familiar with, is centralized companies. So small companies where most everything is done, probably by one or a small number of individuals. But then as the company grows, one person or a couple people can't do it all. So they have to decentralize as they grow. They're going to split off into different departments and segments, and each department or segment is going to be responsible for their area. On this slide, you'll see advantages and disadvantages of decentralization. What we want to obtain is down here at the bottom, goal congruence. We want to make sure each department, each segment's manager's goals align with the overall goals of the whole company, what top management has set for the company. In large decentralized companies, responsibility is given to each department, each subunit. Responsibility accounting is going to provide a system to evaluate the managers on the areas they have control over, especially as it comes, of course, to generating revenue or minimizing expenses. As it says on the very bottom, responsibility center is the part of the organization for which a manager has the decision-making authority and accountability in the results of those decisions that they make. There's 4 responsibility centers that we're going to look at. One thing I want to point out as we get into these is, as you go into your textbook, of course, make sure you look and utilize the videos that they have attached in different areas. They do a very good job of explaining some of these items for you, so that you might not get from me, and I'll give you a little bit more detail and probably a little bit more professionally done PowerPoint or video than what I do for you too. So the cost center, plain and simple, responsible for controlling costs. Like it says, example, the paint department of an auto manufacturer. So we're going to compare our actual cost to our budgeted cost. Revenue center, like the name says, they're only responsible for generating revenue. Advertising sales department of your local newspaper. Profit center, the manager is going to look at both revenues and controlling costs. So this may be a company-owned restaurant as part of a franchise fast food chain. And then last but not least, the investment center. The manager is responsible for the center's invested capital, generally a startup company. All of these areas, as you can see, we're going to compare actual to projected, whether it's revenues, expenses, or both. As you can see on this slide, it shows how the different levels of responsibility and how the reports go. So we start below at the lowest level, the department manager. We move up to the store management level, then we have the various vice presidents of the company, then up to the top level president. Of course, we have the board of directors above that person. As it says, once a company decentralizes, top management is no longer responsible for running the day-to-day operations. So that previous slide, that president isn't going to be telling the department manager what to do. They're going to be doing their thing in managing their department, but the president's going to be concerned with how it fits in to the overall system. So performance evaluation system is just that. It provides top management with a framework for maintaining control over the entire organizations. And as you can see here, the goals of the performance evaluation systems are to promote goal congruence and coordination, making sure everyone's pulling in the same direction, communicating expectations so we all know what our goal is, what our responsibilities are, motivating segment managers. Let those individuals know if they do a good job in their area that there could be some rewards and they're going to be acknowledged for what they did. Provide feedback so they know how they're doing, what they can improve on to make their area more successful. In benchmarking, setting goals that they can try to achieve for their area, their department. The balanced scorecard is that performance evaluation system that management uses to check both financial measures and operational measures of the company and of the departments. They're going to use key performance indicators to make sure the company is achieving its goal. And they're going to look at the company, as it says down here, from 4 different perspectives: the financial perspective, the customer perspective, internal business perspective, and learning and growth perspective. Here's a little bit more in-depth look at our balanced scorecard from the financial perspective. Okay, what is their strategy for increasing revenue and increasing productivity? You look over in the final column and you can see their key performance indicators: net income, sales growth, cash flow. Customer section: how can we improve customer satisfaction for long-term success? Then we look at our key performance indicators: customer satisfaction ratings, what percent of the market share do we have repeat customers, the number of complaints, how are our deliveries, are they made on time, are we getting a lot of returns. Internal business perspective, okay, improving efficiency and effectiveness to achieve greater profitability and customer satisfaction through, as it says, innovations, operations, and post-sales service. Are we developing new products? Is the defect rate of our product very low? How many units are we producing an hour? If something has to come in, how long does it take us to repair it? And then learning and growth. Are we keeping our skilled workers? Are we updating our technology? Or do we have a positive culture so everyone's happy and working hard? Are we maintaining good customer satisfaction? Are we generating financial success? And then our key performance indicators, how much time do we devote to our training of our employees? Do we cross-train them? What's the cycle of replacing our computers and keeping our computers up to date? What's the level of our employee satisfaction or employee turnover? Key indicators of how successful you are with your staff. At each level, there's going to be responsibility reports. It's going to show how the managers are doing at that level. And it's the reports, the areas that the manager has responsibilities for and some control over. They can't be evaluated on things or items that they cannot have control over. Management by exception, as you can see at the bottom, is the principle that upper level management does not need to examine operating details at levels below them unless there's a problem and it's possibly affecting their level. Let's take a look at an example. So here's Macy. Let's assume they have 4 management levels: the president, vice president of operations, store manager, and department manager. So we're going to take a look at each section in a responsibility report and see how it flows from one section, from one level to another. Remember, in this type, in a decentralized company, individuals, managers only have control in their areas. So we're going to look at the areas that they have control over. Here we're looking at expenses. So here's my men's manager of my men's clothing department. You see the areas that they have responsibility for. We see the actual amount this month and the year to date. We take a look at the budgeted amount and the budgeted year to date, and then we take a look at the variances. Are they over or under budget for the year? Then the totals from this department, the managers of the men's clothing department, they're rolled into the store manager's department responsibility report. Here, the store manager has responsibilities for all the departments in their store: children's, women's, men's clothing, shoe department, accessories. And you see the numbers, the totals from the men's department rolls into the responsibility of the whole store manager. Then the report for the store, that rolls into the vice president of operations responsibility report. What are the expenses they have control over? Well, their office, the store that's under their responsibility, purchasing department, receiving department, and salaries of their managers and staff. Then the vice president's totals and of their responsibility report, as you can imagine, roll into the president's responsibility report. And here, the areas that they have responsibility for: their office, and then the vice president of all their subunits: operations, marketing, finance, and the salaries of those department heads. Well, let's go back and take a quick look at our different centers. So as we know, our cost centers, they're going to focus on costs and expenses. So we're going to take a look at a monthly performance report for a cost center. Here it's the Human Resources Department. So you see the expenses they have control over: salaries and wages, training, depreciation, office supplies. We have the budgeted amount, we have the actual amount, and then we have the variance, and then we have the percent of variance. Thing that you need to pay attention to when you're talking about the variance percent, we're looking at our variance. So it's a favorable variance. Our variance percent is based off our variance being divided by our budget multiplied by 100. So 500 divided by 350,000 times 100 is 0.14%. $2,000 variance divided by 10,000 is a 20% variance. Our revenue centers, as we've discussed earlier, focus on revenues. We're going to take a look at the flexible budget variance and the sales volume variance. Revenue centers, as we've said, focus on revenues. We're going to take a look at our sales. What did we actually get in sales compared to what we budgeted? Once again, we're going to look at our variance, and then we're going to take our variance and divide it by our budget to get our percent of our variance. Profit centers focus on generating revenue and controlling costs. Once again, we're going to take a look at our budgeted and our actual. We're going to find the variance between the two, and the percent variance is the variance divided by budgeted amount to get our percent of our variance. Lastly, investment centers. We're going to evaluate the investment centers on two factors: how much they maximize our operating income and their efficiency of using center's asset. And we're going to do this by looking at our return on our investment. Here we have the controllable margin divided by the average actual operating assets to get our return on investment. As it says, the return on investment is one of the commonly used key performance indicators for evaluating an investment center's financial performance. The return on investment measures both profitability and efficiency. Here again is our formula: the segment income divided by the investment base. So here we're going to look at each segment and how they did. We have our income, how much we invested. We're going to divide our income by our investment to show what we've earned on our investment. So for segment A, 10% of our investment generated income. Segment B, 20% of our investment was turned into income for us. In segment C, 25% of our investment generated income. Now we're going to move on to some problems. The good thing with the problems is there aren't too many that we're going to cover this time. And even more exciting, most of them you're going to do yourself. The answers will be out there. You can check your answers, see how you did. Exercise 1, that's all you. Nothing that you aren't familiar with from the readings and the PowerPoints. Number 2, like it says, you have a national chain of hotels and they've broken up decision-making authority. So now you have to classify the managers according to the responsibility center that they are responsible for. We have our cost expense responsibility center, the revenue center, the profit center, or the investment center. Problem 3, Grandpa Jim. He makes homemade cookies from organic ingredients, but his business has really grown and taken off. So now he's brought on some extra people and he's going to have to decentralize. So now we're going to look at the different types of responsibility centers each of his managers is going to have. I helped you out. He brought in a baker, which will be in charge of the production. He has a website designer who's going to be doing sales, and a business manager. So what responsibility centers are they going to be having? Number 4, explain why companies use performance evaluation systems. So we want to accomplish many goals. We want to consider the following actions and state which goal is trying to be achieved by the action. And the goals are listed here for you: providing feedback, motivating managers, goal congruence, benchmarking, or communicating expectations. Like I may have mentioned before, you luck out because I can't call on you in class. Like that's what the in class is going to be getting. They're going to have to be answering this, be put on the spot. At least you aren't put on the spot. Number 5, we want to take a look at our balanced scorecard from different perspectives. We have that right here. Do we want to go from the financial perspective, the customer perspective, internal business perspective, or the learning and growth perspective? So what perspective fits all these categories here listed? 6, now we get to some work. We're given the following information for Far-Flung Company for the year ended December 31st, 2013. Information is organized by functions. So we have plant manager, VP of manufacturing, and president. So we want to prepare responsibility reports for each of the 3 levels of management. Simple enough. So I'm bringing the numbers down. First responsibility report is the plant manager. This manager is responsible for 4 areas: office expense, printing, paging, and packaging. We have his budget and his actual results, and then his variance. So just take a look at office expense. His budget was $7,200. The actual came in at $9,600. So he has a $2,400 unfavorable variance. And we do that for each one. Printing, $19,200 budget. Actual came in at $16,800. So here it's a wash. $2,400 favorable budget. Paging comes in at a $240 favorable budget. Packaging is breaks even. Overall for this department is a $240 favorable budget. This is what this plant manager has control over. Now we're going to take the plant manager's results and bring it to the next level. And the next level is the VP of manufacturing. This person has office expenses, purchasing, receiving inspections, in the plant assets, which we just calculated above, are under their responsibility. Once again, we do our responsibility report. We're comparing our budgeted amounts to our actual amounts and finding our variances. We see our VP of manufacturing didn't do a really good job. My U didn't appear, right? His budget was $100,800. He came in at $107,760, or she did. And we have a variance of $6,960 unfavorable. Now we move on to the president. President has office expenses, and then he or she is responsible for all the areas that make up the business. Vice President of Marketing, the Controller, the Treasurer, VP of Personnel, and the VP of Manufacturing, which we just looked at. We look at the President's office and their budgeted, comparing it to their actual, and we find their variances. So if we look across the total budget from the President's responsibility, what they have control over, their budgeted amount was $604,800. The actual came in at $556,560. So the President's responsibility report shows a favorable $48,240. President's responsibility reports, we can see who's doing well and who's doing poorly, and right off the bat we can see that the VP of personnel and what the manufacturing we just looked at above, they're the units that maybe are underperforming. Now the president can dig in and they can find out what is the issue with these departments and why they may be underperforming. Exercise 7. Joey Bauer Corporation has production plants in Sacramento, Dallas, and Seattle. And below we have the results of each of his areas: the plant revenues, the expenses, and the investment base, which is gross assets. We're going to move all these items in and look at it from a profit center point of view. We have the revenue for each of the areas, the expenses, and the net income. Now we're going to look at it from the investment center standpoint. Their income from each of the areas, their investment base for their areas, and then we're going to divide the investment base into the segment income to get a return on investment. Now you can have answered the following questions based on the information you have up above. Or exercise 8, I'm going to leave that for you to do also. That is it. Exercises we're going to cover for the first section. The first 4 or 5 that you have there, do your best answering them. Check your answers. You only have a couple to calculate here, and then that, but what I showed you should help you with your homework. If you have any questions, reach out and ask me. And like I told you at the beginning of the video, some of the videos that are embedded in your book are very good and help explaining these things. So take a look at them. Good luck with your homework.